All right, here we go. Hi, everybody, and welcome back to yet another cracking installment of the Matt Brown Show. This is the Private Placement Perspective series where we're talking all about venture capital and venture stage investing and private equity investing, and hopefully making a difference to all of you who've been following along on this incredible series. So with us in the hot seat today is Anthony Manna, the Chairman and CEO of M7 Holdings. Anthony, welcome to the show.
Pleased to be here, Matt. Thank you.
So, Anthony, for our viewers around the world who haven't heard about M7 Holdings or all the amazing things that you're doing, evidently, why don't you give us the elevator pitch and maybe paint a picture for us on how did you get your start in the venture capital industry?
Well, first of all, the things that M7 Holdings does is we have three areas that we focus in on. One is real estate development. We have done several $billion of real estate development that we own through a company that I started called Signet, Signet. And we mainly focus in on two areas. One is healthcare, and the other is institutional and free market apartments. The second thing is we also do a lot of private equity where we buy and control manufacturing companies. We have well over 20 now that we own throughout the U.S. with operations in a couple places over in Asia. And then the third aspect is that we invest in, venture capital side. We invest in early stage technology companies, startups, and we focus in on that. I got started, basically, I majored in accounting and finance and went to law school. Started practicing law, mainly in the tax area, and got started buying small real estate holdings, and then started getting interested in buying companies that were headed into bankruptcy. And I started buying a couple of those, and then one thing led to another where now we are where we are as far as that goes. So
it's a very interesting situation because you find firms that are doing venture capital for startups, and that's what they do. And then you find private equity firms, and then that's what they do. And then you got, like, for instance, Ben Lyons, who does real estate loans for real estate developers. So you're quite sort of an anomaly. I've done 25 of these particular episodes now on this series, I should say. And you're the first one I've met that's kind of, playing in all these different aspects, which is really, really interesting. Is that something that you anticipated, Anthony, or was it something that just kind of developed?
No, I anticipated. I'm a huge believer in diversification. And so from the get-go, I was always interested in all three levels. So as an example, when I started doing the real estate, I ended up developing the stadium for the Cleveland Indians minor league team, now called the Akron Rubber Ducks. At the time, they were called the Akron Arrows. Then I used that money to help me acquire a manufacturing company that was a tier 3 automotive manufacturer. Then I also got interested in doing a startup business and taking it from there and eventually selling it. So it's been something that I focused on from the get-go. So it's been very interesting to me.
What makes you guys different over and above the the different aspects of your business? What would you say, or what would you want the world to know about your firm that makes it special or unique?
Well, I'm not sure how unique we are, except that we do a couple things. One is we're very family focused and so forth. So now, as an example, I have 3 of my 5 kids working with me. At the same time, we're also very much into the long haul. We do not buy anything or invest in anything to flip it. We hang on to it. Most of the companies I have, several of them I've had for 20, 25 years, including the real estate. Don't get me wrong. Occasionally we sell. If we get the old saying, you get an offer, you might not be able to refuse it. But for the most part, we're in everything for the long haul. And that, I think, has pretty much distinguished us from a lot of places where they have multiple holdings, whereas we hang on to what we've got for long periods of time.
Mm-hmm. So this might be a difficult question to answer, given the fact that you're focusing on these different things. I'm happy for you to just choose. But when you let's maybe take the venture investing side first. When you're looking at startups, do they have to be at a certain stage or size or in a particular industry? Do you have preferences there? And then the second thing I'd like to ask is, from a private equity perspective, are you looking for distressed assets? Walk us through, where does your interest start to get piqued?
Well, on the early stage stuff, we generally focus in on anything from the seed level to maybe pre-A. Don't get me wrong, I've invested in B's and C rounds, so I don't want to make it sound like I don't. But for the most part, we're looking for the early stage stuff, because our research shows that it's the greatest opportunity for growth, because we want to be in it for the long haul. Second, we also believe that if in the early part we can see that the founder or management team has traction of some sort that we feel comfortable with, then we feel very comfortable about getting into that space. And then third, we also want to make sure they have a significant ownership piece, so they're in it for the long haul and have material interest in it. We generally are looking for things in the agri-tech, robotics, AI area, a few other things that we've gotten involved with. But those are the main areas we look at. But if somebody brings something interesting to us, we've also deviated from that as well. On the private equity side, we're generally looking for long-term businesses that we feel we can grow both organically and strategically. A lot of it's in the manufacturing. We like to have them have some sort of, when I say proprietary, it doesn't necessarily have to be like patent protection, but we want them to have something that the market really likes, that kind of differentiates themselves, and they need capital and other expertise to grow over the long term. So some of that time we're growing it organically. Sometimes it's through strategic acquisitions.
I want to double click on your point around you're in it for the long haul, which I think is great. 10-year horizon's great, maybe longer. So obviously last week, SVB, was it this week? Last week? I can't remember. Anyway, it just seems like it's been an ongoing thing. So I get confused. But, how, having been in the space for so long, for many years now, that these industries that, everybody gets hit. There's a pandemic, and then there's a recession, or maybe not a recession, who knows. But there's, in this timeline of return, there's always these unexpected systemic events, right? 2008, real estate, blah, 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 interest rates now going up, da, da, da. So it's constantly, it's unknown. You just don't know. And so when you are thinking about the macroeconomics around these pillars, let's just say early stage investing versus private equity, and you're in it for the long haul, how much does this play on your mind, this idea of the uncertainty around the macroeconomics? Does it factor? And if it does, how does it factor in your thinking around, say, private equity versus venture stage investing?
That's a great question, Matt. Wow. I would say that I don't want to say it. It does not play a great deal into what we're doing, because there are some deals I've done, like in the 08-09 financial crisis. We did some deals and they turned out to be great, because people were, at the time when we were either investing in the company or buying the company or doing a real estate deal, people were just shedding the assets because they were in trouble. So there's been times where it's been very beneficial, and other times I will say that if you look at certain assets, you may say, because of the particular situation, we're going to wait to see how some of this plays out. But I would say for the most part, we being my in M7 and our family business, we don't pay super close attention to the macro situation unless the business itself we already know is being affected by it, and we're stepping in to acquire it or invest in it. A lot of times, the best business is to go against the wind, so to speak, into the storm, and sometimes we'll do that.
Mm-hmm. Anthony, you obviously, well, I guess my question then is around, I was going to go around LPs, but you're not really a fund, are you? This is your own cash that you're looking to deploy into private equity, venture capital, real estate.
That's correct. Now, we do have some deals we put together where some people have invested with us, but it's on a deal-by-deal basis. But most of the stuff we just acquire ourselves.
Okay. And when it comes to venture stage investing, Anthony, what's the source of your deal flow typically? Is it through network primarily or other sources? And when you do find an issuer that comes along and says, we would like $1 million for argument's sake, what factors do you look for in the venture space to say, yes, I like this guy or this girl, or I'm actually you guys must go away. Your projections are ridiculous.
Yeah. Well, our team, I think, first of all, like I mentioned, we try to find our thesis on the venture capital side is we're going to be totally passive investors for the most part, because we're going to take a minority stake. We're too busy to be on the board. So we need to obviously appreciate the technology and the business. But most of all, we need to see that the business has some traction of some sort. There's many different ways to define that. But for the most part, is the market already accepting what they are producing? They may not have a ton of sales, or they may be early going, but we can generally see that the market is saying, this is something the market's interested in. And then the second thing, and this is probably the most important thing, is the founder or the management team, do they have what I call grit? And what I mean by that is when the going gets tough, and it always does in business, are they tough enough to last it out versus, I've been in situations where people have just given up and walked out the door. And you need to be in a situation where the people running the company, they're in it for the long haul. They have to fight through some really tough times. Can they do it? And for the most part, the companies we invest in, we've been very, very pleased with what I call the grit factor.
I love that, this idea of grit. How do you measure that though? Because I think because the way that I would do it, and you can tell me where you land on this one, but the way that I would do it is, have you failed? Have you lost your shirt in a venture? Because I think there's green investors where they're like, I'm 23, first time founder, hit it. I got some traction. Somehow, somewhere I got lucky. But they haven't lost. Like, I founded 14 startups over 25 years, with a couple of exits, but pretty much everything else died. And so I know what that feels like, and it sucks. But I believe though that your breakdowns are always your breakthroughs. And so that's what I would look for is like, have you failed? Are you experienced enough to know that this is your only job as a founder is to keep this thing alive long enough for it to grow. And, and that takes experience. And sometimes you don't have that. So where do you fall in that one, Anthony?
Well, Matt, again, that's a very good question, very tough to answer, because first of all, I agree with you that part of the factor is it is a good thing if you've seen somebody fail and get back up and try again. I really do think that is a good thing. On the other hand, I've seen some people who keep failing and it really doesn't matter. So part of it is, I'll say this, it's also when you're talking to somebody, you get a feel for the drive inside them. And again, I recognize there's nothing tangible to that. It's hard to measure, but sometimes it's just when you're talking with them and interviewing them or whatever you want to call it, you just come away and say, I know that man or woman is going to step up to the plate, and they may be down in the count, but they're not going to be walking away. I've also seen sometimes where you see how, when you're talking to them, you see how they treat their business like their family. They're in it forever. There are some people you just automatically know as soon as you're with them, it's like, oh, 10 minutes into it, we can stop talking now. I can tell right away. Others, it may take a little while to find that out before you're going to make your move.
Where does it go wrong for you then? Let's just say, think about the last 100 deals you said no to, but they came to you for cash. Was there something that you find comes up time and time again? For instance, like I touched on earlier, like the projections, like you're in la la land, yeah, to your point.
Yeah, I mean, most of the time when we've turned a deal down, it's because they are in la la land. It's like some of these people come into these meetings and they're like, I've invented the greatest thing and blah, blah, blah. My comment to them is, I don't care. My question is, what you've invented, does the market want it? Are you proving to me that what you have has traction? Doesn't mean you have to have a gazillion dollars worth of sales, but it's kind of like my standard joke is, I probably shouldn't be saying this, but I'll make a comment. Look, I've invented the most efficient horse and buggy business in the world. Well, who cares? No one uses the horse and buggy anymore. My point is that some people come up with these ideas. They're just empty ideas. What I like are the people that really sit down when they lay out their business plan. Very conservative, very detail oriented. They have thought it through. They've talked about their markets. They talk about how the market is reacting to their initial, whether it's an invention or whatever that they're feeling this traction with. So, we had somebody that came up, and I can't talk about what it specifically is, but came up with this invention, and it is very obvious the market wants it. Very obvious based on the traction he is getting. He's already had pre-orders put in place. What he needed is capital to get his facility in place so he can manufacture it. Those type of opportunities are few and far between when someone has really done that. And the other thing I should bring up, Matt, for a source and so forth, I'm a huge believer in relationships. So we have some very good relationships with some national organizations, universities, and other types of organizations that bring us deals. But it's more than just bringing us a deal and saying, here, Tony, please take a look at it. Because of the relationship, they genuinely care about us and want to make sure they're bringing the right deals to us to look at, because they know we're in it for the long haul, and the people involved in this, we're going to treat them well.
Mm-hmm. That's really great. When it comes to successes and failures, and I'm wondering whether there's something that you see across private equity and venture, but when you think about those two buckets of investments that you've made over the years, Anthony, do you find, well, firstly, what has been the greatest success and failure, right? And what would you say made the difference?
Well, let me just talk about it on the venture cap. We did a company that we did a startup on, and I'll tell you what ended up happening. This is one of the best success stories on the venture side. So we decided to invest in this technology. It was a startup, and we started look at it. Make a long story short, we found an individual who we thought could run the company. And I told our guy heading this up, I said, fly him in along with his wife for the interview. He tells me, why in the world do you want to interview his wife? I said, just do it, pay for it, bring them both in. So we sit down for the interview. Everything, the homework's been done. We're very interested in this. I don't even bother talking to the husband. I turned to the wife. I said, you're probably wondering why you're here. She says, I have to tell you, I don't get it. I'm a stay-at-home mom. I don't understand why I'm here. And my comment to her was, because you're the key to this whole deal. You see, the most dangerous talk in all of business is pillow talk. And I said, and if every day when the going gets tough, I said, you see, your husband, he believes this business is going to take off, be real successful, all this type of stuff. But I know it's going to go up and down when we start this thing. And when we're down in the gutter, and you've got to be playing tough to make it through. And if every night you're chirping in his ear, you shouldn't have done that deal with Tony. Shouldn't have done that deal with Tony. When we're down in the gutter, he's going to turn to you and he's going to say, you know what? You're right. I quit. So I said to her, I said, you're going to sit through all these boring meetings. And if at the end of the day, you tell your husband that you think I'm a jerk, I will be the first one to tell your husband not to do this deal. Well, Matt, they obviously did the deal. And 15 years later, we had 3 people start. We had over 250 people working there. Sold it, did very well on it. And she called me up the night we sold it. And she goes, Tony, do you remember that interview? I said, I sure do. All she said was, thank you, and so forth. My point to all this is family matters. It matters a great deal. And if you have your family backing you, it's amazing what you can get done. My biggest failure was the complete opposite of that, by the way. I invested a ton of money in another startup, and it turned out it was disaster, and mainly because the guy and his family they didn't respond when it going got tough. They just abandoned ship. We had all types of issues. Believe me, we lost plenty of money on it. So I've had my share of losers, but I usually find the character issue matters. And when I say the character, not just of the founder or the management team, but their families.
Yeah, I get that. Like, it's a stock market graph. That's the journey of an entrepreneur, right? But this is a weird doctrine, isn't there? Like Silicon Valley, it's like, oh look, there's a hockey stick. You know, started a business, 6 months later, it's worth 100 million. You know, whoop whoop. But you know, for every one of those, I'm not saying that doesn't happen, but I'm saying in most cases it doesn't. And for every time it doesn't happen, there's, you know, put 100,000 crushed dreams for every time someone else had went through that same experience. So
yeah.
So
Agreed.
What's your advice, Tony, to a founder looking to raise capital or venture capital today?
The biggest thing is do your homework. Make sure that you've thought about the pros and cons of your business so that when you're talking to somebody who wants to invest, first of all, I think number one, the pros and cons. Second of all, know what type of investor you're looking for. You know, there's certain investors, I mean, we all know them, they want out in a couple of years. Certain investors are like, you know, if you can't get me out, do not come to me. So know what type of investors you're looking for. Like, people generally, when they come my way, they're like, okay, he's in this for the long haul. We get that. A lot of people aren't. But so I would know what you're looking for, know your market, know what you're doing, and so forth, and you'll find. And I guess the last thing, probably the most important, be sincere. That's a big thing. You know, you meet some people and you can tell that they practice the speech and everything, and you just sit there and I'm like, really? I mean, come on. So be sincere.
And I need to be sincere to my sponsors, Tony. So sit right there. I'll be right back. The Matt Brown Show is presented by Carafin, an investment bank that offers and supports direct private investments in U.S. operating companies. Over the past 20 years, investors have placed over $1.2 billion of private debt and equity in more than 100 companies through Carafin and its affiliates. Carafin leverages technology to empower its community of investors to deploy their capital far more efficiently than ever before and connects their community of engaged investors with worthy companies. Invest portions of your portfolio in direct private investments today. Visit carafin.com/Matt Brown Show for more. And we're back. Tony, I'm curious to talk to you about capital structures for a moment and love for you to paint some insight around both PE and VC side of your business. So when you're obviously doing the venture side, there's different types. You use safe notes, convertible notes, all this kind of stuff. where do you fall? Is it usually if you're revenue generating, you like to price the round, or do you go convertible? And so what factors drives your decision making there? And then I'm also curious because you, as I mentioned, you kind of this little bit of an abnormality in the sense of you do PE too. How does the PE side of capital structures work for you too? Is it a case of we're taking controlling ownership at this valuation, that's it? Walk us through how your mind works in those two instances.
Well, talk about the PE, since that's what you brought up last, and then we'll go back to the VC side. On the PE side, yes, we do take majority control on our deals. So if it's real estate or we're buying a manufacturing company or something similar, we take control and we obviously buy the company. Now, I'm a huge believer on those deals that the key management team must be an owner in the business as well. So when we buy a company, assuming, let's say we buy the company and the current management team stays, or we have to recruit a new management team. Either way, they have to invest in the deal. And if they cannot invest, we loan them the money to allow them to become owners in the business. Because I'm a believer that in not just income for them, but I'm also a believer in creating wealth. I want them to be successful. Obviously, if they're successful, we're successful. So when we do the PE side, that's very much, like I mentioned, long-term. We want them to have ownership. I'm a huge believer in that. And I'm not talking about some tiny little bit of ownership. I'm talking about good material ownership. So their families down the long run can be taken care of too when the company down the road was to be sold or whatever. On the VC side, it's kind of a mixed bag there, man. I'll be very candid with you. Sometimes we really like the convertible, notes, the safe notes and so forth. Other times it's just priced in straight equity. Basically, when it comes down to that one, it's a lot of times it's with our relationship is kind of telling us when they bring the deal to us. A lot of times it's what they're recommending. Like if there's a particular university or something, they may be that we have a lot of faith in. It may be that they're making the recommendation, and a lot of times we follow that. Sometimes it's just guys inside doing the analysis said, go convertible note right now. Do not even bother with trying to get an equity play at the moment. So that one, we really are up in the air on that one.
Okay, fair enough. So when it comes to exits, obviously you're in it for the long haul. Maybe there's a strategic acquisition that happens or somewhere along the line, someone goes, hey, we'd like to buy you. They comes back up the line and goes, hey, Tony, this company wants to buy us. So how do you approach the exit opportunity in terms of evaluating whether or not to do the deal? Because remember, I suppose on the PE side, if you want to offload the asset, if you have a controlling stake, that's much simpler. But if you have a venture stage portfolio of 20 investments, or for argument's sake, or 10, and number 3 wants to get acquired, how do you engage at that point? Do you just let the founders decide, or or do you just tell them, look, here's what I would suggest, and you just, kind of just let it play out?
Yeah, when it comes to the VC side, where we're the minority and we're passive, it's pretty much up to the founders to make that decision. I mean, they oftentimes call a meeting of the shareholders or the members, however it's structured, and so forth. And there's been a few times where I've questioned why they need to sell at this particular time. But for the most part, they've thought it through, and it's a good time to sell. On the PE side, when we control that, there's usually one of 2 reasons we're selling. Sometimes out of the clear blue, Matt, we've gotten the classic offer you can't refuse. Like, I still remember this one time we had a real piece of real estate. It was a healthcare. And out of the clear blue, this healthcare system just made this unbelievable offer. And I remember I was at home and our president of the real estate division called up and said this offer. He told me what it was. I can remember saying, so why are you talking to me about this? And they go, well, we need your permission. I said, well, quit talking to me and go get that deal done because there's no one else going to pay that, and so forth. So, and sometimes you get to a point too where as you're growing, and like I said, we're in the long run, a couple things may be happening. One is your partners, meaning the management team, is ready to sell, and that could be a reason to sell. And sometimes you get a company that's grown to a point where you can't grow it anymore. You don't have the expertise or the bandwidth or the investment capital to grow it anymore. And when it gets to that point, you're not doing the business and the people who participate any favors by just hanging around. Nothing goes this way. So a lot of times, sometimes we get to that point of like, we have this big decision to make and we say, look, for everybody's best interest, it's time to move on. So,
fair enough. Anthony, I want to quickly change gears for a moment. So, when you think of the world of PE and venture capital, etc., and when you go to bed at night and you start staring at the ceiling, what's keeping you up at night?
I would say the number one thing that when I look at some of the businesses or investment deals, are thinking about the people. A lot of times I'm thinking about, okay, this particular person is really struggling. What do we need to do to help them? Maybe bring additional support in, whatever it is. At times too, like we're in the middle of something and you see at this point in time, I mean, they're preaching to the choir here. This is where the macro aspects come when you see consistent rising of interest rates. And how is that going to be affecting a deal you're going after, not from your point of view, but trying to figure out what the seller is thinking during this kind of time? Because again, you just never know. Sometimes the seller is really concerned because they're having a tough time struggling. Their borrowing costs are going up, and it's starting to affect the ability of their sales price. Their multiples are going down. You're starting to see this in the marketplace, by the way. I've watched this happen a few times here now. So I would say that most of the time it's people that I'm worried about as far as, and I don't mean worried about them individually like they're doing anything bad. It's, we've got a business problem. How do I help them solve it? And then the other aspect are some of those macro things we talked about earlier. When you're working on a deal, how is that affecting how this transaction is going to move forward?
Yeah, it's it's such an interesting answer because I've asked that question a few times, and often.
Oh yeah, I'm sure you have.
Yeah, and it's. I think what I'm appreciating about your answer is just how much you care about the people that are part of your network. You know what I mean? Whether you invest in them or not.
There's no question. I'm, like I said, I'm a long-term relationship guy. We have very, very close relationships with people. Doesn't mean, we haven't made mistakes or anything like that. But, we're in it for the long haul. And, it's, I always like to say, Matt, we call it a business family. We have to make money, but there's no reason why you can't treat people with respect and dignity and treat them right. So we call it a business family.
Mm-hmm. Amazing. Tony, looking forward, how do you see the world of venture capital or private equity evolving in the next 10 years? And what do you think its impact will be, for example, on startup founders?
Oh, wow. That's very, very interesting. I'm a believer that a lot of governments are really seeing the value of startup ventures, even more so. I mean, everybody talks about Silicon Valley. I get it. I just opened up an office, as an example, in Singapore and so forth, and they get it. And so, but you're starting to see this countries starting to focus in. It's starting to happen in Africa, uh, in the continent there. You're starting to see where these government entities, you could call it a country, the state, a city, whatever you want, are really seeing the value of investing and getting a startup culture started in different places. As an example, I'm in the state of Ohio. You really started to see this really booming in the last 10 years in Columbus, Ohio. I'm starting to notice this in other parts of the country. I'm starting to notice this. So I think 10 years from now, I think you're going to see real combat or desire by these different government entities to really aid the startup community, even more so than they are now.
It's a really interesting point. So my previous company won Africa's Best Tech Startup Award, and it was there was a relationship with the Department of Trade for the UK, and so we wound up going to London Tech Week. And my producer and myself were running around London Tech Week, but really it was the UK government. To your point, it was the UK government on a PR crusade to attract the most exciting startups to London and the UK to open up offices and or whatever. And I went to, it was insane. Like you think PR is kind of like, oh, it's a press release, and like nobody reads. But when a government says, this is our PR strategy, it is like, when I say holy shit, I mean that. It's like you don't, and we were like, I was sitting in a palace, right? With with startup founders from all around the world, Singapore, Asia, South America, Brazil, Venezuela, the US, and they were all paid for to go there to get pitched by the UK government, say, here's our vision. And at the time, this was like, I don't know, 8 years ago. And at the time, Brexit had just happened. And the reason, my thinking is anyway, is that they wanted to reduce the GDP impact, right, of leaving the European Union. And so they needed to do something. And as you know, the ability for a startup to contribute, with venture capital, private equity, whatever, to, healthcare and name your industry, and to make a government or an institution like the UK competitive, right? Because as you said, there was Silicon Valley, and that was it. Like then there was New York, maybe Israel, super embryonic down in Africa, still is, and then there's Asia, which no one really talks about.
Right.
But it was so impressive. It was like I was like, I want to move there again.
Right. Exactly. I totally get it. Yep, I agree with you.
Tony, I'm going to have a quick bit of fun with you, and then we'll wrap up. If you could get into the Matt Brown Show time machine, and you could go back to yourself as a young man, no, like you didn't have what you have today, what advice would you give yourself about investing, venture capital, PE, or otherwise?
Well, I'll go back to something that I would tell everybody who's young that comes to me and we talk about this, something that happened to me when I was in college. And to me, it comes down to the taking risk. And I remember when I was in a business management 101 class, whatever it was, and the professor walks in and he says to the class, everybody put their books on the floor. We're not going to study the material today. Instead, I'm going to have you study a survey. And you're 18, 19 years old, you're rolling your eyes, you can't figure it out. Why in the world would anybody do this? Hands out this survey. What the survey was, and this was around 1980 or so, was they took a survey of men. Now today, obviously they didn't include women, but at the time they took it of men who were 65 and older in Canada, the United States, and Mexico. Did not tell the men what the survey was driving at or what it was trying to achieve, but it took 2 hours to complete. And they published the top 100 answers. What they published was basically what the survey was trying to drive at was, if you had to live your life all over again, what would you do differently? And they published the top 100 answers. Answers 3 through 100, the bottom 98 were statistically irrelevant. there were only two answers that mattered. Number two is the one that everybody always talks about, basically was, I wish I spent more time with my family. But number one was the one that shocked everybody back then. And it was, I wish I had taken more risk in my life. And I remember Matt walking out of that class that day, turning to my two friends and said, when I'm 65, I'm 62 now. When I'm 65, I will not be saying those top two answers. Those will not be my answers. And what I tell everybody is, don't be afraid to take risk and make sure you stay close with your family. Because I think those things are what help you become successful, because you have to take risk. When you have no money, I mean, I started out with nothing. When you have nothing, you've got to get out there, take the risk. A lot of people won't do it. And I think down the road, they regret it.
Yeah, what an amazing thing to end on. Tony, thank you so much for being on the show.
My pleasure.
Yeah, man, it's been really great to get to know you. Stick around. Thanks, everybody, for tuning in, and we'll see you all again soon.